Hi, David and I hope you guys are all safe and sound, and thanks for joining us in this month's educational video. Today we're going to talk a little bit about what the common traits are for successful investors.
We're not going to be delivering any hot stock picks or trying to hit any home runs with today's educational video because, in our opinion, being a successful investor really is about a sustainable process, and really the most important thing is all about controlling your emotions through market cycles. So we hope you enjoyed today's video, and we'll talk again soon. In our view, there are 4 keys to being a successful investor that will allow you to steadily accumulate wealth over time. They are, number 1, resist the urge to time the market. Number 2, take advantage of market volatility. Number 3, be aware of how your emotions can impact your investment decisions. And number 4, start investing early.
As humans, it is in our nature to try and foresee danger or risk and prepare to avoid it. It's our human nature that leads so many investors to try to time the markets. But timing the market is exceedingly difficult to do with any reliability. Over years, we have seen firsthand many examples of clients trying to time the markets. Sometimes these market timers end up getting lucky as they move to cash and then the market dips temporarily. But more often, they will move to cash and the market inevitably takes off and they miss out on serious profits. A recent example of this was that some market timers were inclined to get out of the market before the 2020 US presidential election. And lo and behold, November 2020, which was the month of the election, was one of the best performing months for stock markets in 2020. Whenever this happens, the market timers convince themselves that despite missing out on some gains, they ought to stay on the sidelines and wait for the next correction before getting back in. And they end up costing themselves even more in missed opportunities the longer they are not invested. This chart illustrates the risks of trying to time the market. To obtain a return that is as good as what it would get if you remained invested 100% of the time, you would need to make the right timing decisions 60% of the time, which is rather unlikely. This does not even consider the fees, taxes that may be incurred each time you enter and exit the market, which can erode your returns significantly.
Another thing that successful investors do is that they take advantage of market volatility when it presents itself. When the market is down, whether it's down 10, 20, or 30%, successful investors recognize that there is an opportunity to profit from this. Your personal financial situation will dictate whether you are able to seize the opportunity when it presents itself or not. If you find yourself in a position where you are living paycheck to paycheck and you don't have much excess cash flow or available credit, it's going to be difficult for you to take advantage of market volatility because you don't really have access to any money to invest when the opportunity knocks. But for people that have savings built up or have equity in their home, a market drawdown can be an excellent time to utilize that equity or savings to buy into the market aggressively. If you are someone who customarily does a lump sum RSP contribution at the deadline every year, you may want to consider making your RSP contribution earlier in the year if there happens to be a sizable market correction. Or if you're someone who owns their home and can borrow against the equity, you may want to consider utilizing some of this equity to buy investments the next time the market is down more than, say, 15% from its most recent peak. In this chart, you can see what taking advantage of market volatility can do for your investment returns. If you invested $10,000 in the US stock market on January 31st, 2007, before the financial crisis, and then sold your investment at the bottom of the market on March 31st, 2009, and invested in a GIC thereafter, you would have had only $6,642 at the end of 2015. If you did nothing and just left your investment, you would have had $17,220. If you doubled down on your investment and invested another $10,000 at the market bottom, you would have had $46,776 by the end of 2015.
Another key principle to successful investing is to understand your emotional state and to be aware of how your emotions may be impacting your investment decisions. Your emotions can cause you to make rushed decisions when it comes to your investments. To manage your emotions, you should identify the scenario in which you may act irrationally. For instance, when markets are performing well and your portfolio has grown at a nice clip, you may need to be aware of becoming too willing to take on risk. After a string of good returns, you may have bragged to your friends or family about your investments. These positive vibes, sometimes bordering on euphoria, may make you more willing or even feel a sense or desire to take on more financial risk. Typically, when your investment portfolio has gotten some nice results, this is an opportune time to review your asset allocation and considering reallocating some of the profits to areas of the market that have underperformed or shifting some of the profits you have earned on stocks back to less risky assets like bonds or cash. In the opposite instance, when markets are experiencing turmoil and volatility, you have seen your portfolio value diminish, your emotions will naturally kick into high gear, and you may feel any combination of fear, anger, or panic. If your emotions really get the best of you, you may capitulate and make the gravest mistake of all, which is to throw in the towel and sell all your investments during a market downturn. In the instance that you are contemplating capitulation, this is often the point of maximum financial opportunity, when you would be better served by investing new money or adjusting your portfolio assets to increase your exposure to stocks. This can be a difficult thing to convince yourself to do when the markets are down significantly, and simply staying the course may be difficult enough to convince yourself of. Selling at this point is the worst thing that you can do. This has been proven time and time again throughout history.
Another thing that successful investors do is rather simple. They start investing. To a degree, it doesn't matter what kind of investing you're doing. You may choose conventional investments like stocks or real estate, or maybe you like art as an investment, or perhaps you know a lot about sneakers and so you're inclined to invest in limited edition Air Jordans. Whatever it is, getting your money invested in some type of asset class that has a proven track record of increasing in value over time is better than leaving your earnings sitting around doing nothing for you in a savings account. And the earlier you start investing in something, the better. This chart shows how legendary investor Warren Buffett's net worth has grown over time. It's interesting to note that some of Buffett's best investment returns came back in the 1940s, 50s, and 60s, when his net worth was not very significant. In recent decades, Buffett's investment returns have been less impressive compared to earlier in his career, and yet it's been in the last few decades that his net worth has expanded most significantly. Buffett's net worth growth is an example that it's time in the market and not timing of the market which creates real and significant wealth. So the earlier you can start tucking some money aside for investing, the more it will pay off for you as time goes by.
As always, if you have any questions, please don't hesitate to give David and myself a call.
Take care, guys.